Welcome back, everybody, to another episode of Take Back Control Tuesday. Now, I can't tell you what the outcome is going to be for each and every one of you, but what I can tell you is for the next hour and 40 minutes, the time we're going to spend together, if you apply what you learn, this will change your financial future. If you're here, that means you're ready for change. And tonight, that's exactly what we're gonna deliver. I've got a special guest for you. His name's Jason Sipple. He is a master of what you're gonna learn. But what are you going to learn? Well, Jason is gonna teach you three things. He's gonna teach you how to take back control of your money by being your own bank. And then he's also gonna teach you how to build wealth through your own debts and expenses. That'll be the second thing you learn. And the third thing you'll learn, hence the cars, you're gonna learn how to get all the money back for every single car that you ever buy, drive, and own. And before you get into it, one last favor, just click that button right there, the subscribe button. It would do me a huge favor. And also, right above is a little bell. Smash that bell so that every time I put new content out, you'll be notified. So I don't want to waste any more time. It's time for Jason to really show you all about the infinite banking concepts. Let's roll.
Take back control.
Tuesday night.
Tuesday?
Welcome, everybody. We will give everyone, it's 1:01, so we're holding time integrity. We will be having some fun together. I am super amped up. I've been looking forward to this all week. As always, every time I get the opportunity to speak with people, because it's going to land differently every time you hear this. Some of you have been here for all the Take Back Control Tuesdays. So I'd ask you right at the beginning, what is the next step for you? What is the thing that you really want? What is the thing you envision? Ready? So who wants more money? Who wants more control of their money? And who here, show of hands in the chat, wants more freedom? Who here wants to feel financially free? What would that feel like? What would that do to your relationships, with your family, with your peers, with your coworkers, with yourself? Think about what that feeling would feel like. It'd be like being a child and being free. I'm going to let you in on a little known fact. The wealthiest families and visionaries like the Rockefellers, Walt Disney, have been using a strategy called the infinite banking concept for ages to build and preserve their empires. The strategy is simple, it's legal, and it's something that each and every one of you have access to. And it starts with just changing one thing. Starts with paying yourself first. Shockingly, as you'll see, we're giving away a big chunk of our money every time we get paid to the bank, to the government, to Wall Street, to others. It's leaving our family forever. So get ready as we dive into the infinite banking process, where you can make money with every car that you buy, drive, and own. We're going to show you how you can turn your debts into assets, how banks make their fortunes with your money, and why, as the big man Tony Robbins says, success leaves clues. And how can you apply these breadcrumbs being left for you? We're going to go through real life examples, show real world applications that you can do right now and put you in a position of building, keeping, and creating more wealth. Remember, it's a process we're teaching. And remember, Rome wasn't built in a day. And we're going to work on our long-term thinking and our mindset together. All I'm asking you here today is to keep an open mind, because what I'm sharing is some paradigm shifting information. Let's get started. So now I want you all to think you're in a room with 100 18-year-old new grads. And they're in the room because they want to learn how they can be financially free in the future. What's it going to be like if we fast forward to when they're at retirement age? We fast forward almost 60 years later, and we ask these 100 18-year-olds, they were full of energy and excited to be there and just thinking about their future, what they're going to do together. We say, hey, who here is going to be financially free at retirement? Man, they would shoot their hands up. They would jump out of their seats. They'd be so excited. They wouldn't even wait to be called on. They'd be screaming, I'm going to be the next Elon, the next Mark Zuckerberg, the next Bill Gates. I am going to be a millionaire, a billionaire. I'm going to have so much money. I'm going to have so much success. And then we fast forward. And what happens? What happens to their dreams? What happens to their enthusiasm? Something happens. We're only 5, right? Only 5 out of 100 of those 18-year-olds end up financially secure. How is this even possible? We live in the most abundant time in history. We live in the greatest country in the world. Still, no matter what your feelings and no matter what's going on in the world, it's still the most free country where we have so much abundance. Our lives are easy. If you're here with me, our life is easy. We have access to everything. How is it that these 100 intelligent, enthusiastic 18-year-olds, only 5 of them become financially secure? That doesn't even mean wealthy. That means they just don't have to go back to work and start working at Walmart or a fast food restaurant or your local grocery store after they retired just to be able to pay their bills. Well, as you can see, the shocking statistic, only 5 of those 100 are reaching financial security. And why is this? It's because we don't understand the rules of the game that we're playing. Einstein says you have to know the rules of the game and then play better than everyone else. Another quote that I love is from this brilliant man. Think about this. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. That just ain't so. So a lot of what we've been taught about money or not taught about money might actually not be the truth. I need you guys to keep an open mind because in this webinar, I'm going to challenge the way that you think about money and the way you use your money. A great question to write down in your notebook, write down in the chat is, what is your money doing in this situation? So let's get started. Let's go into this. Who am I? Why am I here? I'm going to give you a different version of my experience so far. So I believe that the quality of our life is a direct reflection of the quality of the questions we ask ourselves with our ability to take radical ownership of the thing and to be like Nike and to take action. When I was 26, I had pretty significant spinal surgery. And afterwards, I felt pretty good. And I asked the doc who did the surgery, kind of messed up the surgery. I said, hey, doc, what can I do? I've always been an athlete. What can I do now? And he said, Jason, you're done. You're done running. You're done lifting. You have the back of a 60-year-old. And in my head, I kind of flipped him the double bird and said, dude, that's not true. I'm 26. I'm not going to not move the rest of my life. And I went out and I did 5 full Ironmans, 20 halves as well, but the 5 full Ironmans with that back, with the back of a 60-year-old, because someone told me I couldn't do it. And you know what? I didn't accept that. It's no different than what we're going to talk about today. When I was 46, I had built a $25 million recruitment division. And when I looked around, I had given up Ironman to take back control of my time with my family. I had taken a leadership role and built that division in 3.5 years. We scaled that company from $30 to $600 million. And when I looked around, I'm like, this is awesome. The people, the mission, what we're doing. But my reality is I was making what I was 5 years previously. I had 5 times the responsibility and I was working 30 hours a week more with no equity in the company. I'm like, dang, man, what my family taught me to show up first, leave last, work hard, be humble, add massive value to every single person you meet and treat everyone like you would treat yourself, right? The golden rule. I follow those principles to a T my entire life, and it does not equal financial freedom. So when I ask for help, when I ask for a financial philosophy, I ask a mentor who I realized, man, I don't know what I'm doing. It doesn't matter how much I make. I couldn't overcome some of the laws we'll talk about in this presentation because I didn't know the rules of the game. So when I asked for help, when I learned about this process I'm going to teach you, everything shifted, not only internally, but result-wise, as long as you're willing to take ownership and do the work and think differently. So let's talk about who else talks about this. who else do you guys maybe know, right? You guys are already in. I haven't acknowledged you yet, so my bad. You guys are already in the 5%. 95% of people will never see this presentation. They'll never be here to invest their time, their most valuable resource, their time, their energy, their focus on learning what we're showing you today. So already, congratulations. Give yourself a hand, a high five, pat yourself on the back, move around a little bit, be a little bit interactive, have a little fun. So who talks about this concept that's really well known and someone that you would trust and turn to? Let's look at some of these people. Maybe you know the first guy. The first guy wrote a book about a rich dad and a poor dad, and he's written a lot of other books. He is someone who talks about the importance of cash flow, and his name is Robert Kiyosaki, and he writes about this concept in Second Chance. And then we have the guy I mentioned on the first slide. Guys, changed my life, showed me what's possible, what we're actually built for, what we can do, how we're just limited by our patterns, by our beliefs, is the big guy. Tony Robbins, section 5.2, Money Master the Game, talks about the power of whole life insurance. And then finally, you got this book, R. Nelson Nash's. Now, this is the cover that you guys might know. R. Nelson Nash's Becoming Your Own Banker. This is a book that I read one night. Don't be impressed. It's only 91 pages, right? With big pictures and giant font. Don't even need my glasses to read that book. But when I read that book, it changed everything. That book will fundamentally change everything. And if you don't get it the first time, it's okay. Read it again. That's what I did on the second day. And I thought, if this was true, every American would do this. And then we got my esteemed colleagues, partners who have written a newer version of Becoming Your Own Banker, which is Mapping Out the Millionaire Mystery. And then you got Chris, who wrote the Private Money Guide, who shows you how to work just like the banks do, which I'm going to show you here in this presentation. So let's talk about an interesting concept. Let's talk about riding a backwards bicycle. Who learns quickly? Who can learn something, see it, and apply it almost immediately? Kids. Think about when you were a kid. Go in the Wayback Machine if you're as old as I am, or maybe not as old or older. Go in your Wayback Machine, see it in your mind's eye, see yourself riding a bike for the first time. See your mom or your dad running behind you, pushing you and letting you go. When they let you go and you push down the pedal, what happens? The bike goes forward. When you turn right, what happens? The bike goes right. When you turn left, the bike goes left. For me, it's still one of the greatest freedoms on earth is going out and exploring on your bicycle. Even in hot Florida, it is still one of the favorite things in my life is riding a bike. Now imagine if some twisted person decided that, hey, I'm going to change one thing on the bike, and when you turn the bike right, it's going to go left. When you turn the bike left, it's going to go right. Who here could ride that bike? Show of hands. If I said, hey, whoever could ride this bike, I'll give you 10 grand. Who here could ride that bike? How many of you? I think I could, but I know that's not true. I know that's just my ego talking. Paul wants 10 grand. We would put Paul on that bike. If you guys go watch this, I'm not going to spend much time on this, but go watch on YouTube the backwards bicycle. It's fascinating how our minds work. It just shows you that once we have been patterned and conditioned to do one thing, it's really hard to break that pattern. The guy who actually taught himself to ride the backwards bicycle took almost 2 to 3 times longer than his 8-year-old son. And then when he tried to ride a regular bicycle, he couldn't do it. This is what we've taught or been taught about money. Learning something new is incredibly challenging since we've been conditioned to think a certain way. And this is true about money. So what if I told you everything you've been taught about money isn't true? Would you be open to thinking that that's possibly a fact? Again, shifting the mindset can be difficult, but it's not impossible. Think of it as riding a backwards bicycle. And so I want you to write this down. Write this in your notebooks, whether you're using a pencil, a pen, a marker, whatever you have, or typing it in. Writing's better. It stays deeper into our grooves, into our neural pathways. But write down, give yourself permission to acknowledge that you just might not know how to do this yet. Give yourself permission that you just might not know how to do this yet. Simple phrase. Those 3 extra letters, yet, makes all the difference. So let's look, before we jump into the mysteries of money, why aren't more people successful? It's 2 parts, right? Wealth building, money has 2 parts. It's always the mindset and the math. So when we look at some of the wealth killers, think about the times we live in right now. Inflation probably jumps out at you. Taxes, the volatility of the market, the up and down, the boom and bust cycle that we're all going through. Interest, right? Higher interest. Talking to people who bought cars in the last year or two, interest has went from like 2-3% to 7, 8, 9, 10%. Our money is worth less every day. So this inflation, the taxes, the things, it makes it really tight to do what we were doing a couple of years ago. And then the other part of it is the mindset. It's following the status quo. It's feeling like, hey, I'm just going to do the ostrich effect and stick my head in the ground, or do no, and it's all going to be okay in a couple of years. It'll all be fine. It'll just work out. I'll just keep doing what I'm doing. I'm not going to ask new questions. I'll just keep plowing forward without stopping and doing what, Will Rogers said that we don't do. It's the problem in America is not what we don't know. It's what we think we know. That's just not so. We don't take the time to think, to really think. And so it's the fear. It's a friend of mine wrote, Plucking the FUD, fear, uncertainty, and doubt. So let's look at our beliefs. Let's look at what we're taught, and let's see where there's some rules that we can replace with something that's going to be a little bit more empowering. And so while we're here, let's jump in to the mysteries of money, right? Now, again, I want you to all hold space that what you already think is true might just not be true. So what's the simple definition of money? Pop it in the chat, be interactive. The more you're interactive, the more you're going to take away from this. So what is the definition of money? There you go. Now I can see everyone. Before I can only see the hosts. So the definition of money, right? Money is nothing more than a means of exchange, right? We think about this. We pay money for a car, car for money. Money for a house, house for money. Money for food, food for money. It is just an exchange in value. It is nothing more than a value store. I like that. It is options. Yes, I always ask, do the wealthy have more choices? Right? What do you guys believe? Do the wealthy have more choices? Next question. What company uses compound interest? You guys are going, whoa, me, call on me, Jason. Call on me. It's the banks. Some of you are thinking that. Some of you who haven't seen this before are thinking it's the banks. Well, let me ask you this. When you walk in, you've just made your paycheck. You're strolling in, feeling good. You're going to deposit. You go up to the teller. You pull out those fresh bills. You hand it over to the teller. Do they take your money, write your name, Jason, Jafari, Derek? Do they write your name on that $100 bill and just take it and put it in your little special box, and it just sits there? And it just grows in compounding interest. So when you need it, you go back and now your $100 has turned into a couple hundred because it's compounded over years? No, the banks understand the law of motion, right? It's just a law of nature. Things in motion tend to what? Stay in motion. Money has to stay in motion to make more money. Our bodies, to be healthy, we have to exercise. We have to walk. We have to stay in motion. Water. We're not going to fish from a stagnant pond. We want things to keep moving, right? So, law of motion. No company uses compound interest. So the banks, they just give us suckers, dum-dums, and we leave happy. Oh, I got the cherry. I got the root beer. What's your favorite flavor, right? You think they're sending us a message? You guys. And here's another one. This is something where we first see it and you're like, oh, I don't know, Jason. Are your dollars worth more now, more today, or in the future? Think about this. If you took $1 10 years ago or 20 years ago, how many candy bars could you buy? A lot, a few at least. Today, that same money, that same dollar won't even buy you a half a candy bar, right? The king size bars are like $2.50 or more. So our dollars are always worth more today than they will be tomorrow. Right now, the money in your wallet, the money in your account is the most valuable it'll ever be for the rest of your life. Okay. Next question. Taxes. Are they going up or are they going down in the future? Are they going up Are they going down? What do you guys think? Up or down? Or another way to ask this question, up. There you go, April. Is do you want to pay taxes on the seed or on the harvest? I don't have a crystal ball. No one here knows for sure. There is not a person on earth that can actually factually say taxes are going to go up or down. We don't know. But if we look at the writing on the wall, if we look at the inflation in the economy, if we look at our government being $34 trillion in debt, if we all fast forward to our retirement age, our made up age of 67, however many years that is for you, then you say, okay, well, do I believe that my taxes are going to have to go up to pay for the government? Remember, the government doesn't earn money. The government just taxes at a higher rate, or what? Spreads a bigger net to tax more things. And there's an unseen tax that is inflation, that is money, more money going into the system, which I'll talk about in a webinar tomorrow. But taxes, most likely, they're going to go up. And we want to pay taxes. Regina, is that true? We don't want to pay taxes on the harvest. We want to pay on the seed when it's small. Today, when it's small, we don't. Here's another way to tell this story. Imagine this. I want you guys' opinion. Have you had a business partner? Now, this business partner is the best business partner ever. They will never bother you. They're going to be there with you through thick and thin, but you'll never hear a contrary point to whatever it is that you're growing. You take that harvest, or sorry, that seed, that little seedling, and you plant it in the ground, and it grows, and it grows every year. It grows from thousands of dollars to tens of thousands to hundreds of thousands to maybe even millions of dollars by retirement age. And you're like, yes, I have enough to live off of for the rest of my life. I have accumulated money. I have built wealth. I have this massive harvest. I am so excited. But you forgot what? You forgot you had a business partner. And that business partner comes back in and be like, hey, Jason, remember me? No, not really. We're business partners. We've been business partners for this whole time. You've taken that little seed and grown it into a harvest. I was like, cool. What do you want? You've not been here. I want my cut. And I want my cut to be, I don't know, I think 35% should cover my costs I need right now. That is the game we're playing with taxes, okay? And this goes into my next point, that story. What do you know about your retirement account? What do you know about your qualified plan where you're putting your money today? If you know how it works, if you're growing that money, if you're intentional about it, awesome. If you're like me and many of the people, the thousands of people I've spoken to, all we know is what? That money goes up, that money goes down. Is that money guaranteed to grow during your lifetime? No. Is there guaranteed to be more than you put in? No. Right? It's like, do you want to take on more risk? Do you want to retire later? There's never an option C. So I understand this might be a lot to absorb. I kind of stayed here a little bit longer today, but I want you to start thinking differently about what you've been taught about money, the traditional way to think about money. But to truly build generational wealth, you need to challenge these old concepts and understand how money truly works. So let's go through. You're all here for the money multiplier method, right? So let's go through the three parts, the three steps of the money multiplier method. First, we're going to talk about the machine. What is this machine? What is this magical machine for what we are creating with the money multiplier method? I almost gave it away. Then we're going to talk about the marathon, the long-term thinking. Remember in the beginning, I said we're going to tie it back to long-term thinking. And like I shared in my story about myself, I won't run a marathon unless I've already swam 2.4 miles and biked 112 miles. What's the point, I think? I don't love running, but I'll do it to complete that race because it's such a big deal. So, and Regina, same. Most of us here, same. But thank you for being here. So with the marathon is the long-term thinking. Remember, the rules that got us here, short-term thinking does not answer the long-term vision of what we want to create, which is what? Freedom. And then finally, the millionaire mystery, right? We're mapping out the money multiplier method, the machine, the marathon, and finally the millionaire. And I'll show you factually with a spreadsheet how you get to be a millionaire or a multimillionaire. It just depends on how much you're able to use what we're teaching you in the principles today. And now you're wondering what this machine is, and I'll tell you. And I'm not going to give away the punchline to this slide, but the machine is nothing more than a dividend-paying whole life insurance policy from a mutually owned company. Wait a minute. What? Jason, what are you talking about? Whole life insurance? You've had us here for this whole 27 minutes to talk to us about specially engineered whole life. Yes. Yes, I did. Yes, I am. Yes, I will continue to do so, because there is something here that we're not seeing. We haven't been taught, because again, we're being groomed to give up control of our money and to what? Assume all the risk. This vehicle, as I'm going to show you in the next slide, here's a fun interactive little thing we're going to do. We're going to draw this T chart together. In the top left, I ask you all to write the bank. Top right, write the policy. Please be interactive, fill this in as we go. Don't just watch, write it down. Under bank, write the word liquidity. Under policy, write the word liquidity. What do I mean by liquidity? Write it in the chat. What do you think I mean by liquidity? That's right. Liquidity is access to the money. It's not locked up, put away, keys thrown away in financial prison. The money's not locked up where you can't access it. You have access to it. It's like your bank account, okay? In the bank, 0.07%. This is the average percent that's paid, or interest rate that's paid by conventional banks nationally. 3.25%. This is a contractually guaranteed rate by one of the 5 mutually owned dividend-paying whole life companies that we work with. It's one of the higher ones. The bank, taxable. That 0.07% is taxable. I just talked to the guy I was on the phone with before jumping into this call. He's like, hey, I've got all my money, my savings, earning 5%. And I'm like, cool. He's like, it's like $1,200 a month. I'm like, that's awesome, man. But that money's taxable. He's like, it is. You're right. Okay. Well, what if it wasn't? What if the growth in the policy was tax-free? You pay, like I said, you pay taxes on the seed and all of the growth, all of the distribution, all of the loans are tax-free. We'll say them once because we're good citizens. Don't ever pay them again. Don't pay them more than you need to. It's how you keep more money. The bank, unstable. What do you mean by unstable? Think about Silicon Valley Bank at the beginning of 23. What happened there, right? Northern California, Silicon Valley. Run on the bank, bank fails. A series of banks followed that. Then we had banks in New York, banks in the Midwest. All the way through the beginning of this year, banks were failing. People were getting insecure about the economy. And when they all run to take their money out, guess what? There's a reserve, but it's not enough to cover all the money, so the banks fail. It's called a run on the bank. Well, the policy, these institutions are stable. Think about this. They're all stable. They've all been profitable for 100 to 137, 147 to 160 years consecutively. Is that impressive? Show of hands, anybody put an I in the chat if that is impressive? Think about all the things that's been stable through since the late 1800s, early 1900s for one. That means the Depression, World War I, World War II, any war that we can think of, you know, all the way back to the Civil War, basically. Profitable every single year. Profitable every single year. And then finally, in the bank, the money's unprotected. If you're a business owner and you get sued, liens and judgment, that money in your regular old account is accessible. The policy, the money's protected against liens and judgment. Right? So it offers you more protection. And then, that's right, that's a great point. The insurance companies were the ones bailing out other companies, right? They're lending money to banks. So my last question for all of you in this fun T-chart is, where do the banks keep their money? Where do the banks keep their money? If you scream policy, you'd be right. And I want you guys to research all of the things I'm teaching you today. Look it up in Google, ask Uncle Google. Hey, Uncle Google, tell me about BOLI, bank-owned life insurance, right? Banks have quadrupled the amount of specially engineered whole life that they have since 2013. They now own over $202 billion with a B, $202 billion of specially engineered whole life. That's more than all their buildings and their land combined. Do you guys think the banks know something that we don't know? That's why I'm here. That's why I'm teaching this to you guys. Do you think the banks know something that we don't know? Remember, just follow the breadcrumbs. Follow the tips for success.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
Now I'm going to take you on another journey. Let's talk about how your money flows, right? We're going to assume that you're like my buddy Sally Saver. You're paying yourself first. You're following the first two commandments, right? Love God, all of our heart, mind, and soul. Love thy neighbor like thyself, which means that we pay ourselves before our neighbors. God, us, neighbors. So we are saving up for this, pick your favorite color, for the shiny new car. A leather interior, smells great, and we're saving our money at a bank. And in this example, in this story, I'm going to be Jason, your local community banker. And I love my job. I love people. I am there to help you. And so we're going to see how much trust you have in Jason the banker here in a moment. So you're saving $25,000, right? You're going to save $25,000 over a period of time that you put into the bank. And it's earning you, because I'm a lovely guy. You guys are earning 4% with me. 4% on all that money. Compounding, growing, uninterrupted, as long as you don't take it out. But as long as it's saving, and you're saving, you're being like Sally Saver, you're practicing discipline, not regret, because you want something, you have that vision, that goal. And then you come in, when you've saved the money, you have your eye on that car. You guys all picture the car you would buy. And remember, it doesn't matter. We're just using 25,000 as an example. If you want a Ferrari, just add a zero. It works for a Ford Focus, works for a Ferrari. Same principle. But you come and you're like, hey, I want all my money, Jason the banker. I want that money so I can go buy this new car. I'm like, hey, congratulations. I've seen you working so hard to save up this money. I see how diligent you've been, how disciplined, how excited you are. Congratulations. But I've got an offer for you. I'll keep paying you 4% on that money year over year. I'll give you a loan at 6% for 60 months. And your payment back to us will be $483 and change per month. And at the end of this 5-year period, you're going to make money. You know, Sally, you're going to make money. Do you believe Jason the honest banker? Can you keep your money growing at 4% and borrow at 6% over the same time period and make money? Do I got you a yes or a no? What do you guys think? Are we making money in this scenario? So I'm going to show you the math, and it might surprise you what the answer is. So if we do, and for me, this took me 19, I counted it, times to understand this. 19 times in like 4 months. So again, if you don't get it today, just say I don't get it yet. But you can go pull up a time value money calculator, do a future value calculator, and you can figure this out and look and put any number you want in. But that $25,000 at 6% for 60 months, that future value is $28,999. The compounding is going to be that 4%, 25,000 is 30,525. Which number is bigger? The paying at 6% or the compounding at 4? The borrowing at 6 or the compounding at 4? Well, unless you do math different where you're at than I do here in Florida, right? You've made $1,526. You've made money compounding at 4, borrowing at 6. Most people say, hey man, you're at -2. So again, remember what we've been taught about money isn't always true. We have to understand, what is the money doing in this scenario? In one hand, you're paying down a debt, so it's getting smaller and smaller and smaller, right, at 6% over that 5-year period. On the other hand, the compounding uninterrupted is getting bigger and bigger and bigger every year. So now that you understand that, let's look and start understanding, how do the banks make money? Remember, we're a super generous bank. We're giving you money at 4%. Remember, the national average is 0.07%. So we're super generous, like 4 times more generous, 5 times more generous, 6 times almost more generous than anybody out there, right? So now, because I'm so honest, you're going to come in and give me $100,000 into our bank. What am I going to do? Am I going to just say, hey, thank you, I'm going to go put it in your deposit box and keep it there? No, remember what I teach you earlier. The money has to stay in motion. It has to move. So what am I going to do? It becomes a liability as soon as you put it in and deposit it. So I'm going to go ahead and I'm going to lend it out. I'm going to lend it to a home buyer at 7%. That home buyer is going to pay the seller, and the seller is going to do what? They're going to deposit the money back in the bank. Remember, it just keeps the money in motion. Now, me being the banker, I'm already in a good position with the home. Now I'm going to lend the money out again on a card. The first time I charged 7. This time it's not as much collateral and it's a depreciating asset. So I'm going to charge 8%. And that money comes back from the dealer. And what am I going to do? I'm going to what? Lend it out again. I'm going to lend it to a home remodel. Your wife, your husband, they want their new office, their new kitchen, their new bathroom, a guest room for their parents, right? Or like a mother-in-law suite. So now we take a 9% loan out, right? And then the money comes back. And then last, now we have debt consolidation for all the things that we thought we needed in our life, that we wanted, and we went and bought, and we pay money over time. And all of a sudden we're like, wow, this is killing me. This average 23.5% on my credit cards, I'm giving away every month, year after year. I'm going to pay this off and I'm going to do a debt consolidation. So we take another loan out at 12% for our credit card debt, and now we're paying that back. So let's look. Remember, only $100,000 was deposited by you at the beginning, and it's been lent out how many times? 1, 2, 3, 4 times. Now, so let's look at the difference. So the first example, we've got 7 minus 4 is 3%. The next one on the car, 8 minus 4 is 4%. Right? You guys follow me so far? And now with the next one, we have 9 minus 4, which is 5%. And then finally, we have 12 minus 4 is 8%. So if you guys are doing the math at home in your head, right, what do we get? We get 20. You add those up, you get 20. So remember, we're making 4 and the bank's earning 20%. Well, that's, 5 times more. No, it's actually 500% more, right? 20% is how many times greater than 4%? 5 times. That's 500% more. And the banks had how much risk in each of these scenarios? Barely any, right? They could foreclose on the home, take back the car, close on the remodel. The only one that's risky a little bit is the debt consolidation, but they make, if you look this up again, keep Googling all the things I'm telling you, go ask Uncle Google. Banks make between 400 and 1,300% on the money you leave there. The gentleman I was talking to before this call, that blew his mind. They're paying him $1,200 a month. They're making 400 to 1,300% more than that. That's crazy. That is crazy. This is what it looks like, and this is how banks are making their money, and this is how they're creating money out of thin air as well. So let's talk about us Americans. So we're kind of outlining the problem. So let's look at how we spend our dollars. Now this tracks back true all the way back into the 70s, okay, even I think to the 60s. If you go do your research on this, we're going to talk about every dollar we make and how we spend that money. So think about, as you're going through this, think about your own scenario. I want you guys to really apply this, take ownership of this, to understand how do we give up control of our money and how others, the bankers and the creditors, are rewarded. So let's dive into what's happening in the majority of Americans' households. So first, we spend 20 cents of every dollar on our automobile. Most people spend a lot more than that, right? A lot more than 20 cents, but we're just going to give you the average American. Now, the next biggest cost is what? Our housing at 30 cents of every dollar. Then we have everything else, which is 40 cents of every dollar. And that leaves us, that's 90. So that leaves us saving 10%. Now we know that this is being really, really, really gracious. Right now, our saving is down to 3% or less as a country. So we're giving you another 7% here. So what we're taught, what your financial advisors are teaching you is like, okay, let's see where you're spending your money, the needs in your life, what you're paying on a monthly basis, and whatever's left over, remember, paying neighbors first, whatever's left over, that's your savings. That's how we traditionally look at money. But what if we just shifted where the interest went first? What if we took back the function of banking in our life, right? When we look at this on our automobiles, we're paying 5 cents in interest for every dollar that goes out towards our car payment, towards insurance. So putting 5 cents back in, that brings you immediately up to 15 cents of every dollar is being saved. Okay, you guys follow me so far? Now with housing, if you bought a house in the last 7 years, do not, I beg you, I plead with you, do not go home. Do not log into your Fannie Mae or Freddie Mac or Penny Mac or whoever holds your loan. Do not log in and look at the amount of interest you're paying. It will shock you. It will shock you. It's about 70 to 80% of every dollar for the first 5 to 7 years. Because why? Are the banks smart with money? Do the banks know how to make more money with your money? Yes. We're paying 25 cents of every dollar. So add another 25 cents in. That savings is getting bigger and bigger by just what? By taking back control of our money, by just changing one thing. And then we have 5 cents on everything else, right? Now look how much more money you'd be saving here. So this is on average 35 cents of every dollar. Would all of you want a 35% raise? Do you think that would make your life a little bit more comfortable, to give you a little bit more sense of peace, of financial stability? Think about that. Now we're going to go into one of the coolest things. I want you guys, when you're driving around today, wherever you're going, driving home from work, to the grocery store, taking your kids somewhere, I want you to think of this. I want you to look around. Look around. Don't close your eyes. Don't do the other visualizations that I'm talking about, but look around and see the kind of cars that are driving around your hometown. You know, maybe you live in Florida like I do, and you have these, we're going to talk about raise the hood, pick up the hood, and show you how you're going to make money back on every car that you ever buy, drive, and own, right? Buy, drive, and own. So as you're looking around, look at that car and wonder, how did that person pay for that? There's only 3 ways. Well, I guess there's 4 ways they could have got it, but we're going to talk about the 3 honest ways. They're either leasing it, which is renting it. They paid cash for it, which means they'll never earn money on that money again. Or they financed it, which means that they're paying interest to someone else, or they've stolen it. But, you know, you probably don't want to go steal a vehicle. It's not the best way to have freedom. So let's look under the hood of the machine. Let's show you an example of how you can get all the interest back and make money with every car you'll buy, drive, and own. Seems too good to be true, but let's look under the hood. So first, we're going to talk about the premium deposits. Why do we call them deposits? Because think about when you get paid, when money gets deposited into your account, how do you feel? Make the noise. Make the noise in your head. Make the noise at home. Feels joyful. You feel happy. Maybe you laughed. Maybe you smiled, right? It feels good. So we're going to call it premium deposits. Our age doesn't matter. The death benefit doesn't matter. We're going to put in, like the example with Jason the Honest Banker, we're going to put in deposit $10,000 a year as our premium deposit. In year number 3, now that we've had discipline, now that we've been paying ourselves first and putting our money into this machine, we're going to go ahead and take a loan out, right? And we can take a loan out without any questions. No hoops to jump through, no blood to give, nothing. Once you have your policy, your special engineer policy set up, you can borrow at any time. So we're going to go in year 3. We're going to take out a loan like, hey, I need 25 grand. Here you go. and you're going to go buy the vehicle of your choice. Remember, again, this works. This is just the numbers we're using for this example. If you're buying an Escalade for 100 grand, a Ferrari, whatever you're buying, just change the numbers, change the amount of zeros, and you can make it work. And so then over 7 years, you're going to have deposited $70,000, right? You're going to pay yourself back because you've taken back the function of banking, $500 a month times 12 is $6,000. So now you've paid yourself back. $100,000 has gone into your specially engineered account, right? And we've taken a loan for $25,000, and that leaves how much? $75,000 left, right? Well, if you look, our cash value, we look at the right column on number 7, our cash value is $67,000. We have $75,000 that's been injected into this, but there's still $67,000 in the account that we can use. So this means that we have recaptured what? 91 cents of every dollar. Now here's where it gets better, right? Here's where it gets better. This is when you start making money on every car, because why? The uninterrupted compounding interest is getting more and more efficient every year. So now we're going to do something we would never, ever, ever, never, ever, ever do. We're going to stop making deposits. Remember, we've got one car in our driveway that we paid 25 grand with a policy loan, and we recaptured 91 cents of every dollar. So it's the same as you when you look at all these people driving their BMWs, their Teslas, their nice cars today, and you look around, you say, I wonder how many of these people have bought a vehicle and at the end of the 5-year period have had 91 cents or every dollar back. The answer is probably 0, unless you're practicing what I'm teaching you today. So in the second example, year 8, we have the cash value. We're going to buy a second vehicle, and we're going to do the same thing. We're going to be the honest banker. We're going to pay ourselves back. And so now over that 5-year period, we put 30,000 back to ourselves, right? 500 a month or 6,000 a year. We've not paid any premium deposit. Remember, after year 7, we stopped. And what happens? We've added 30 grand back in. We've taken another loan out. That's $5,000. But wait, no, it's not. Our cash value has grown to $91,473. You subtract that from the cash value in year 7, we have made money, $23,000, and it cost us 5 grand for this vehicle. Is that not crazy? You have put in 67,000. And so what are the rules that we have to follow to make sure that you can apply the same thing? The first rule is we want to pay ourselves first. I've talked about this several times already, but again, repetition, teach, train, test, repetition. Pay yourself first as if your life depended on it. Number 2, to be an honest banker, pay yourself with interest, right? If you have to pay the bank back with interest and be an honest banker, don't you want to treat your money better than you're going to treat the bank's money or the bankers and the banker employees? Of course. And we want to recycle or capture that money. We want to keep all of that money in our family. If this works for a car, what else could it work for? We're only limited by our imagination. So whatever you think it can work for, it can. It's like Henry Ford said, you either think you can or you think you can't, but either way, you're right. So let's go through and talk about debt. About 90% of the people I talk to, even if they've saved money, they still have some kind of bad debt on their books. This is one of our actual clients. We map this out for people. We show you the math of it, not only the mindset, not only the teaching, because not only teaching you how to fish, but I want you to look at this and say, how can I turn my debt into an asset? Again, it's like Einstein says, you have to know the rules of the game and then play better than anyone else. So what's better than becoming, after you've learned how to make money, job 1, job 2 is taking back the function of banking in your life. So we're going to look at one of our actual clients. He's 45 years old. He's got 9 third-party debts, which are up on your screen right now. $478,774 in debt. Total monthly payment, drum roll please, $5,770. If he just paid it back with the terms that he set these different purchases up with, he will take 19 years to pay the money back. So he's saving $25,000 a year. He already has discipline with that. So let's look and see what happens if he opens one of these specially engineered whole lives and deposits that money. In year one, he's going to take a loan. Remember, it's a marathon. He doesn't have access to all of it in year one. He has about 58% access. He's going to take a loan for $14,000 and change. And he's going to do what? He's going to pay off and take ownership of the Discover card and the Lowe's card. He's recaptured how much? $448 a month. Would any of you like to have $448 a month back into your circle of wealth, your wheel of wealth? I bet you would. Let's go to year two. Year two, another $25,000 deposit. He has a little bit more available. He's going to pay off the next 3 debts. So already in 2 years, he has wiped out 5 of the 9 debts. Now we add that money, that 276, 271, and 922. He has now recaptured $1,900 a month, almost $24,000 a year. Remember how we're getting 35 cents of every dollar back. That is what I'm showing you right here. I'm illustrating what's happening in each of our lives if we have bad debt. Year 3, saves another $25,000, makes a deposit, and look, already he's reached an efficiency point. He has more cash value, $541 more than he's deposited. He's paid himself back that $1,917 per month, $23,000. So he's $48,000, and he does what? He pays off the Beamer and the boat. So we're turning his antics, his fun, his lifestyle into a cash machine for his family. Now he's recapturing $3,600 a month. That's almost $40,000 a year. So let's talk about the marathon. How much has he put in so far? $25,000 year 1, $25,000 year 2, $25,000 year 3. You guys can add that up, right? 3 quarters, $75,000. Loans year 1, $14,000, 2, $16,000, year 3, $25,000. $55,000 in loans. How much is left in the policy? Pop it in the chat. Pop it down below. How much is left in the policy? 20 grand? You guys think that's fair? 75 minus 55? No. All 75,000. You never, ever interrupt the compound interest that is growing and being saved. Remember, this is a save and spend method. So now let's fast forward and go to year 4. We put another 25,000 in. It grows a little bit more. Payments back to himself of 44,000. Total cash, 70 grand. Doesn't pay anything off, but knocks down the condo to 26,000 left, right? Year 5, same thing. Cash value goes up again. Payments back to himself, 71,000, and total cash back into his wheel of wealth. That does what? Pays off the condo, recaptures another 879, pays down the house. In year 6, something unique happens, right? He's putting in the cash value deposit, but now, puts in 10,000. He gets cash value 13,000. But now his warehouse, he's got too much money. He can't store all of that money into this policy. So he's already starting a second policy, a second warehouse. It's like banks do, right? Banks have a bank on Main Street. Then what they do when that bank becomes profitable, they open a bank on 3rd Street, 5th Street, 7th Street, etc. Or the question is, can you put 16 ounces of water into an 8-ounce cup? The answer is no. If you said yes, I'm sorry, but it's the wrong answer. In Fun Energy, you'll be okay if you said yes. But so now this doc starts a second account, puts 25 grand in, has the 14,000 and change in the second policy, payments back 54 grand, 82,000. And year 6, the doc has recaptured all of his money. And a brilliant thing that we've added, the money multiplier has added for your journey this year, is we will show you this during the process. We used to wait until you had a policy approved, enforced, but now we've added this debt blaster. You guys are wondering, some of you are math-minded, you want to know, is it better or faster if I pay off the highest interest first, the lowest payment, and snowball it, the highest to the lowest? Like, what is the most efficient? We will mathematically meet you after you've done part of your application gotten through the process, we have a team that will show you this debt blaster, and they'll show you how long it takes to pay all the debts. They'll map out your millionaire mystery, right? And then once your policy is enforced, this will be reinforced with your implementation specialist. You get assigned somebody that's going to meet with you, be your student driver, show you how to take out loans, how to pay back loans, how to do all the things. Because why? Knowledge without application is not powerful. It just makes you sound really good in conversation, but doesn't change anything. There's no action. Knowledge without action is just ego. We want to take action. So you have this implementation specialist, and I'm going to ask you a really profound question. You guys have been awesome. I'll shake it out a little bit if you're still with me. You know, what are you thinking? I want you to know, or I want to know, how do you eat an elephant? You guys have been quiet for 30 minutes. How do you eat an elephant? You're probably thinking, I don't want to eat an elephant. That's huge. How am I going to do that? Well, you eat an elephant one bite at a time. We have creativity, elephant steaks, elephant stew, elephant salads, elephant burgers. We find all different ways to make the elephant. And so the man at the top of the mountain didn't just fall there, right? Had to do the work. You had to invest the time doing what all of you are doing. Again, acknowledge yourself. You are the 5%. You are the ones that are already here. And so I'm going to ask you a quick question. Is it possible to owe no man nothing? You know, once you decide that you want to be your own banker, the verb, the action of banking, you've added a second business to whatever else you serve others with. This machine works for everything. Again, we're only limited by our imagination. So let's look at the chiropractor's example of paying back the condo and the home. If he kept being the honest banker and continued to pay back the money as promised, what does that look like? What does that look like? Remember how I said we're going to map out the millionaire mystery? When we look at it, when we continue to pay back those debts, that $879 a month for the remainder of the term, which is 251 months, and the home, $1,221 at 224, he's paid himself back because he's the honest banker, paying himself back, feeding the machine. That's right. $493,000. $500,000, folks. Yeah, that's over a lot of years, but you're going to pay that out anyhow. So now you have control of this. And even better, it gets better. You've been earning a guaranteed interest on that money the whole time, and most likely dividends. So this is under promising, and now we're at $750,000. $750,000. Plus, you have the house, the condo, maybe you still have the boat, the Beamer. You have paid for all of the things and kept all the money in your family. Oh my God. That's crazy. That is crazy. Now that you know this, wouldn't you agree that everyone should do this? If you know this and you don't take action, you're stealing from your children. You're stealing from your grandchildren. You're stealing from the people that you haven't shared this with. That's harsh, but think about this. Once you understand the rules of the game, if you're not applying them, then you're making that conscious choice. So now that you know this, everyone should do this. And by the way, we didn't focus a lot on what? The death benefit, which is a second guarantee. We didn't focus on the loans never have to be repaid. We talked about being an honest banker because that's what we teach. And we didn't really talk about the growth being tax-free too much. I did mention it. Or the fact that the policies are exempt from judgment liens. Also mentioned, but we didn't spend a lot of time there. So as our buddy Warren Buffett says, if poor people would just do what rich people do, they wouldn't be poor anymore. Profound, right? Easy. So when we look at the two choices of things that are going to happen in our life, there's only two things that can happen, right? We're either going to live or we're going to die. Are we better off with or without this in either scenario? The answer is with. Again, the answer is with. And so right now, I want to thank you. We've done this in 1 hour and 3 minutes. I want to thank you for giving me your most valuable resource, your time, your energy, and your attention. You've done what 95% of people will never do. They won't watch this, they won't learn about this, but you have. You have. So you have a decision that's here for you. You have a decision that you can either start your journey or you continue learning. Either way, you're right. but one has action, one is gathering more knowledge. Do whatever you need to do. But if you want to have a free strategy session, if you want to talk about how you can become your own banker, book a call with me. That is my calendar for a free consultation. I will meet you where you're at financially, have a conversation with you, and map out how you can take back control of your money, turn your debts into assets, and make money with every car you buy, drive, and own, just like I promised I would. So I have a few minutes at the end here. You guys have been awesome. What questions do you have? What questions do you guys have? Pop them in the chat. Let me know how I can help. I have a couple of frequently asked questions I'll answer if I don't get some questions. Like, how can I get started? Well, book a call with me. Let's see, I'll pop it in the chat. Give me a moment. So here it is in the chat. You can book a call there. I can also, there'll be a replay of this. I'll be available for you on our YouTube channel, so you guys can watch it again. You can share it with others. Next time you come, next time, every Take Back Control Tuesday, bring a friend. Tell someone else. Do service by bringing others, because if you show other people this, what are they going to think about you? Man, that Regina, that Jeffrey, that April, that Frank, that Carrie, they are smart. They are doing what others are not doing. Carrie asked the question, what is the smallest amount of money need monthly to begin this type of plan? So Carrie, super common question. And I would say it depends. It depends. You know, we mentioned that it can be up to 10 times your age, but the whole point of this, think about this. When you buy car insurance, house insurance, health insurance, the question is always, how much coverage can I get for the smallest amount with a reputable company, right? Is that fair? With this, our question is really shifted. Again, the paradigm is shifting, and we're saying, how much can I put into this machine, into my policy, with the smallest amount of death benefit? That's what we do. James Davidson says, so great question, Carrie. It depends. I want to know what the person's solving for and then can make recommendations about that. You know, so we'll walk you there, get you there. But again, it's a shifting of how you think about this. James, what is your preferred way to use cash value in your policy? Well, it's building, keeping, and creating more wealth. Great question, James. Building, if you have debts, that's a guarantee. So recapturing and recycling that money, that is usually the best place to start. If you have what? If you have cash flow, because all we're doing is changing the one thing. Where does your surplus, your savings go first? The second part of that is building or keeping wealth is all the cars, all the purchases, all the things you're going to buy anyhow. Why not do it through your system and make interest on that money? Your money just goes further. As you saw, 35 cents of every dollar being given out to other institutions, to the neighbors first. We want to keep that money in our family. The third part is creating more wealth through investing in something you know, like, and understand. Remember, I'm not a financial advisor, but I like, James, we've done the whole journey. That's why I can come teach this. Like I am, you know, as anyone on the Money Multiplier team, we're all practitioners. So we first use this to recapture and recycle about $3,300 of debt a month. Second step for us was paying taxes, going on vacations, using the policy for things that we were already going to pay for anyhow, and then just paying ourselves back. Now I'm about probably a month out from creating more cash with the cash in our policies. So that's the next thing I'm exploring right now, is creating more wealth. And I'm learning that through my peers, through people who have already been there, done that, and learning what I'm going to know, like, and understand. So great question. Considering gifting this to a child. Kelly, that's awesome. It's a child policies, a great question, great place to start. It's based on the parents and their coverage, their earnings, other things. So it's just reverse engineered. We do it all the time. We're super knowledgeable about. As far as a digital dollar, I mean, you're setting up ACH transfers with the money going from your current banking system into now your own banking system. So the dollar's been digital for a long time. So I don't think anything's changing there. Is it wise to funnel everyday expenses through a policy? Margaret, that's a great question. Thanks for being here. I would say probably not. Eventually, after having this set up for a while, the idea is to have every dollar we make go through our systems of banking, right? Like some of my peers, I have 4 of these set up for my family. Some of my peers, like Brent, who started the Money Multiplier, has 28, right? We have like Chris Naugle, I think he has a dozen. So those are how you would eventually, you could use the interest you're earning to pay for the everyday things. But Margaret, we want to look at where are we going to make a spread, whether it's investing in our business, whether it's something we're going to purchase, the bigger things. It's not a checking account. It is where does our surplus money go first? And what is better to start with, this velocity banking or the... That's a great question, Kelly. So if you don't have surplus money, then we look at velocity banking as it's just the movement of money. Remember, it is the velocity of money. It is using the money. And we'll show you in that debt blaster how just rather than being 19 years, if you use the velocity method, it would go down faster, but it even goes faster when you're using cash value. So those are, if you can combine the two, it will go faster. If you don't have surplus, recommend starting with velocity banking and working your way up to when you have surplus money and then having a conversation with us. Gotcha. You personally, so all three, James, I gave the story, right? Recaptured 39 grand a year that was going out to third-party debt. That's our Ford, our Hyundai, a water filtration system, debt consolidate. I've made all the mistakes, folks. I'm not standing up here in front of anyone saying, hey, I have this all figured out and have my whole life. This is a new habit that you apply. This is a process. It is something you constantly have to work out. R. Nelson Nash talks about in his book, the fifth principle is use it or lose it. You either keep doing this or you fall back into old habits. So that is something that we've used to bring back all the debts, the interest and principal back to our family. We've used it to pay for our ski vacation with my son's policy, right? We've used it to pay taxes for our payroll taxes through our business. And now we're going to use it to put that money out to work to make interest on that money. So all three. Where do you get set with velocity banking? You can go to Christy Van. She's one of our partners, Vantastic, Heather, and check out velocity banking. Learn more from her channel. It's called Vantastic, like VANN-tastic. And then Sean is going to email this out either tonight or tomorrow. It'll be edited and beautiful on Chris's YouTube channel here within a week, I think. Let's see. That is it. Well, again, super blessed to have been here with all of you. Looking forward to next time I get to come back. Next week, you'll have another money mentor here. They will do an amazing job. Keep learning. Keep telling yourself whatever you didn't get today, I just don't get this yet. Give yourself permission to be successful, to have financial freedom. Be blessed. Be awesome. Keep learning. Appreciate you guys. Until next time, have a great one.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.